think we're live on all three platforms now. Fun topic for you tonight on common investing traps. If you are at home or if you're here live, if you want to raise your hand, if one of these traps affected you, you don't have to raise your hand. That's embarrassing, right? But I can say as we put these together, certainly these are the common ones, and I've either fallen for these myself, or I've actually been close to falling for one. So let's go with the disclaimer. Here we go. You can pause that if you're at home to go ahead and read through that. Standard information, in my opinions, and my opinions alone. All right. First, the psychology of investment traps. So investing is an animal like no other, right? Everybody competes, or most everybody does as a child. You compete in either sports or clubs or events, that sort of thing. And you have emotional responses to all of that. And that's all well and good. And there's some people that cry it out. I know in volleyball, when you go to 12U, they say no more crying on the court, right? That's when you're done with that. Well, with investing, not only are you competing, but also you are getting to a point to where your actual money, your future is on the line. Like you just worked a 12-hour shift to make your, say, 120 bucks, and then you invest in the stock and watch it go down 10% overnight. That may get to you, especially if that continues. So you kind of have to understand the ups and downs of investing. It is a roller coaster. It is not a straight line. And those are some of the traps that we're going to be talking about tonight. Okay, they're not scams. This is you versus you. This is you protecting yourself from your preordained biases, if you will. If you do fall for these, it's better to discontinue that and then learn from it than to continue to go through this. And you want to move from the reactive instinct to a disciplined strategy. You know that we have the book coming out soon. You've probably seen that on our emails and social posts. It's called Thesis and Conviction. A lot of tonight's presentation is going to talk about having a clear thesis of why you bought something, and then your conviction is how much you believe in it, right? So using those two things together so you are not scared and make a dumb financial move when you have a headline that you don't like. Okay, let's talk about the yield trap. When you think of yield, that's how much, if you know that if you own a stock and it kicks off a certain percentage dividend, say it's a $100 stock and it kicks off a $3 dividend annually, that's a 3% yield, okay? If that stock goes down to $50 and it still pays that $3 dividend, you're actually getting a 6% yield on your money. So there's a little difference between dividend and yield. But if you remember back in the day, or for a lot of folks when they just get started in investing, you do searches in these stock screeners. And I will tell you that the stock screeners will always lead you to Crapsville. Because you'll find a place like Flower Foods where if you search for a low PE ratio, that's good. That means it's supposedly cheap, correct? So you have it to where you have a cheap stock, but it has a nice big juicy dividend, right? Well, that together, and then you look at the chart and it's like, well, things don't, you look at the chart and you go, well, things don't appear to be going that good for Flowers Foods. So the yield trap is buying a stock or bond solely because it has a normally high yield, high dividend or interest rate coming off it. So the warning signs, we're not going to talk about payout ratio, but if you want to get nerdy, you can go into the ratios. And if they have profits and they're paying more out to their dividend than they have in profits, that can't last forever, right? That's more than 100% payout ratio. So that's a sign. If you get anything over 5%, I think you really need to look at, because it might be a distressed asset like Flower Foods here. Flowers Foods that dropped so much. So focus on free cash flow if you know what that is. If not, you can look it up. Or just dividend growth. If they're increasing their dividend every year, that shows that they have the ability to pay, because they're paying more and more every year. Okay, so that is the yield trap. When it comes to, there's a lot of fancy, you hear us rail against financial engineering, because a lot of times it's complete BS. You get into where you have these financial wizards with good ideas, and they make things super complex, and they don't work as they're supposed to. You read how this is going to work, and then it doesn't work. So with the YieldMax series, this happens to be a YieldMax Tesla type stock that is kicking off a big juicy yield here. So on the last one, we looked at flowered foods and it was kicking off like 7 or 8%. This option income ETF is telling you in that big box in the red that in the next year, you are going to get paid a 96% dividend. So you put $100 in, they're going to give you 96 back. Is there any math in the world where you think that's sustainable? Right? No. So what's going on with the price of the stock, though, is you have in the chart, it's going to zero, right? So they're basically taking your money and then they're paying you these ridiculously high dividends, and the stock itself is going to zero. And if you hold it long enough, you just won't have anything, right? You'll have picked up some dividends along the way. So just keep an eye out for stuff like that, because it's if it looks too good to be true, it absolutely is. And if you need a second opinion, obviously that's when you would reach out or go to Grok or any of your AIs and say, this looks too good to be true. They'll be like, hey, looks like a yield trap. Okay, recency bias trap. If something's winning, they were always going to win. Or if there's a loser out there, you're always going to lose. So let's talk about my favorite football team, the worst team in the NFL, and that is the Vegas Raiders. Now, just because they were bad for the last several thousand years doesn't mean they're going to be bad this coming year, because they've got a new coach and they've got the #1 draft pick, which we think is Fernando, coming in to save the day. Last year they got an all-star running back. The year before that, all-star tight end. They have one of the best defensive players in the NFL, and then they have a hot mess. Emphasis on the mess, not the hot. Going on with everything else. They have Tom Brady supposedly overseeing this thing and making things better. So recency bias would be, well, the Raiders suck, they're going to suck again. And I can feel the heat in the room. Okay. But I'm just here to tell you, there are some things that maybe they get it figured out this year. Well, so how has energy been as an investment for the past decade? Yawn, we don't invest in energy. Well, it's the leader of the pack so far in 2026. What has been the leader of all the whole time is tech, right? So you go down towards the bottom. Third up from the bottom, you see information technology. Over the past 10 years, it's up 770+%. We like that. We've been investing in tech for the past 10 years. But when it rains in Techville, it hurts. And it's hurting right now because energy and materials, yawn, are up. Caterpillar's at a 52-week high. What? But the stuff that we've been counting on, the Mag 7, the big names are off this year. So that does happen. So it's called, thinking what just happened is always going to continue to happen. So when you look at a stock chart, a lot of people wait for new highs before they hop in and buy the stock, right? They don't like it at 50, but you put $100 price tag on it and they're like, yeah, it's going to the moon. Or if a stock's going down, they say, well, I better sell it because it will obviously go down forever. Things do not do that. So those are things to kind of take a look at, is because the one thing I like to do with clients is I take a piece of paper and put it over the chart, the historical chart of what has happened. And I said, okay, you can only see today's price and think about where this is going in the future. And that helps kind of get rid of that bias that you've had in the past. The reality down there, markets are cyclical. So if you want a truly diversified portfolio, which again, we seek alpha here, so we do take some focused positions in the portfolio. But if you're just going to do what I call the Edward Jones 60/40 type portfolio, where you're just trying to lock in the averages minus the fees, you are going to own all sectors. And then if you don't have something going down when the market's going up, you're not fully diversified. We try to avoid the things that are going down. Same sort of thing. If the whole market is going down, you should have something going up. That means you're fully diversified. So again, that is a theory that's out there. Again, we try to focus to avoid the sectors that are going down. Okay, the speculation trap. If you're paying attention to investment sort of things, this year has been a hot year for silver. So if you're not a silver expert, and it's kind of like Facebook, right? So the PhDs in Facebook that are allocated after about 15 seconds after a news event, then all of a sudden the PhDs from Facebook come out and tell you exactly what's going on, all that stuff. Same thing, maybe in Minnesota or with the drama at the Olympics, whatever it is. Same thing happens in the investing world. Is somebody that's never invested in silver or any other precious metal in their whole life sees that silver is going up. It goes from 70 all the way up to 110, and they say, oh my gosh, it's obviously going. There will be some person on TV, because they have to make sure people watch TV, so they put the extremists on. Somebody will be on there going, yeah, silver's going to 500. So then they buy. They have no expertise. They really have no, well, they have PhD in Facebook. So they're telling their friends, it's like, hey, this is what you need to be in. And you buy it, and then all of a sudden there's the big rug pull. That's about a 40% move down there. And then you swear that you're never going to invest again because it's all BS and it's rigged. So if you are speculating, don't go into things you don't understand, right? Speculate on at least something you know, like Apple stock, or it may not have as big a move left in it, but at least it's something you kind of know and can understand versus just going off into silver or silver futures or something like that. So if you want to speculate, because you just can't help yourself, because DraftKings account it's at zero, Kalshi's at zero. They've blocked your bank or your bank's blocked them. So where all you have left is your Robinhood account to have your fun in. Then at the bottom, use the core and satellite approach. Go, this is like my future. This is like, I don't want to mess with this, but you can take up to 5% and do some speculating on the side. And then when you've had your fun and that portion goes to zero as well, then stop. Don't just take the 5% of the remaining amount. I've seen that before. As you said, 5%. It's like, dude, that's a one-time 5%, not the rolling 5%, right? So that's your way to defend yourself against that. Okay, this is the single hated slide, my most hated slide in the slide deck, because I can't look at the slide without it like making me mad with that thing going around. So for some reason, the one on the main screen is not going around, but the other one is. So I'm just gonna hold my hand on it. So if you were to see the full slide, it would be going around in that wheel. So a couple things I have to say is that a lot of people think they need to be active in their investments. A lot of people need to think that every day when you check CNBC, that if you see a headline and it's about your stock, let's say Tesla, there's a Tesla headline, is a Robinhood stock. Negative headline today. And then it's like people call me, it's like, what are you doing with Robinhood stock? It's like, well, thesis hasn't changed. I'm actually not doing anything. So a lot of people are raised in an environment to where if they see something, they have to do something. Investing is not that way. You do not need to always just hop in and do something. You need to ask yourself why you bought it, and does that reason still hold, or doesn't anymore? If it doesn't, then you sell it. Otherwise, you just simply hold it. I learned this in the Air Force. One of the funniest things I'd ever heard back when I was pretty young, so mid-20s, and bar talk somewhere, and one of the weapons officers said, he goes, he's like, Cruiser, the key to Air Force leadership, right? And I was like, no, right? I'm like, oh, here comes some wisdom, right? It's like, shit, I want to write this down. He goes, never simply react when you have the time and energy to overreact. So I paused for a second while I processed that, then I started dying laughing. And honestly, you see that in maybe relationships. You see that in work environments. You see that in team sports a lot, to where, yeah, there's something happens and then there's a huge overreaction, right? It's actually taught in the military. Leaders, honestly, if something goes down when you're a squadron commander, they will literally call you in and say, what are you doing about it? And you literally have to have laid some law down or come up with some new requirement or put some PowerPoint together to, one person craps their pants, we all have to wear diapers for a week, that sort of thing. And that turned into like literally military leadership. Relaying that to your portfolio. You can go days, weeks, and months without touching anything in your portfolio. Don't forget that CNBC and all the other business news, if no news happens in a day, they have to broadcast 24 hours a day. So if there is no news, then they will make up news for 24 hours, right? Because they can't just go, well, we're off air, see you back in 3 hours when hopefully something's happened of interest. So remember, if there's no news, they still have a full bucket of news. And when they can't find anything interesting, they go out and they find the extremes, right? The the crazies on both sides. Also, CNN and Fox do a little bit of that as well. Okay, get rid of the hamster. I wonder why I didn't spin on the other. So, okay, sunken cost trap. See this all the time. Folks who come in, one of the things they're like, hey, can I talk to you about finances? Like, sure. How can I help you succeed? And they'll, generally pull out a statement and say, hey, this is kind of what I've been working with. I either don't know what I'm doing, or I don't like what I'm doing, or I'm not getting the results I want, or I just want your thoughts on it. And you'll see the stock that has gone down 99.9% and sitting there at 1 penny or $0 that they bought 7 years ago because their buddy told them about it, and they won't sell it. That's called the sunk cost fallacy, right? So they don't want to sell that stock because it's admitting defeat. They don't want to sell that stock because then if it comes back to even, then they would be appalled, right? That would be the devil that would drive you crazy. But in reality, when things go to zero, they stay at zero. The only time I saw it where a stock went to zero and came back and flourished was it was an airline. I think it was United. And this person had a statement and said, "Hey, I held my United Airlines stock through going zero, and now it's I can see on TV it's like $130, but my statement still says zero. So obviously my statement's wrong, but I have all this money." It's like, well, so your company went through bankruptcy, so they killed off all that stock, so the zero is correct, and then they issued new stock, which now flourished. So I mean, if you're seeing zeros, you can go ahead and call it good. Uh, you know, you don't want to keep these things around. Now, I will also say this. So that's from a financial management. There's a tax savings if it's in a taxable account and you hold something, say you lose $5,000, you could write that off your taxes. If you don't sell it for 10 years, you can't write it off until you actually sell it, and it's not coming back. So go ahead and clean up your book, sell that thing, get it off of there so you get the tax savings. Another way to look at it is I don't really put little post-it notes up on the mirror in the morning saying, "Steve, you're a loser," because that would not be helpful for anybody's mental health. I don't really have any that says you're a winner or anything. I don't think, but looking good. But whenever you look at your statement, you are acknowledging your own idiocy if you keep those things around. You're like, "Wow, was I an idiot? Look at all these stupid investments." That's not the energy you want to bring to the investment game because it's not easy, right? There are bad days. There are days where you need to like turn the lights off and go to bed, and it's like 6 p.m. It's like, I don't care, I'm out, right? Bad day. So you don't need to bring more of that on yourself because you're holding on to your losers, thinking that there's some miracle that's going to come around and save you. Okay, one of the things I started the firm on, uh, primarily because I came from an educational background right at the end of my career. I flew fighters operationally, then I went into education training command for my last few years. And you had to explain things a lot more. In ops, you just point jets and go and kill and blow up and come back and have a drink. No, in education training command, you have to like explain how you do all those things. So I got a lot better at explaining things in simple terms. So when I went into the investing field, I said, okay, I want to be able to explain any investment in 30 seconds or less. And if I can't do that, then I shouldn't put a client into it. So that's what I use. I would say most people don't hold themselves that strict, but I certainly want to be able to have a reason, that thesis, and be able to communicate that thesis. If it's a structured product out there, like an annuity, so if you've ever had an annuity presentation, they're on point. They are literally like going to, if you're old enough to remember Amway, or if you've ever been to a timeshare presentation, these are PowerPoint slide decks that have been looked at by millions upon millions upon millions of man hours. Every word, every slide, every picture, everything is completely crafted to sell you on this idea. Insurance is the same way. Annuities, they promise the entire world. If you can explain it back to them by the end of that, you good on you, right? We review their annuities and we try to explain it to them, and they're like, "I had no idea there's all this stuff," right? It's like, "Well, I thought I got long-term care insurance with this." It's like, well, you do, but it's good for Tuesday through Thursday for like 3 weeks, and you pay $30 a month for that. Or I thought this was tax free. It's like, not all of it's tax free. There's a portion that's tax free, right? So if you can't repeat back to somebody what they're trying to sell you, you probably just don't need it. Um, so the marketing materials is one where you can kind of see it sometimes. It's too good to be true. It's like all upside, no downside. It's like, well, that's obviously not the case. So try to keep things simple out there. And a warning sign is if you get a statement from a financial firm that's like 50 pages long, you could already go, why? They're hiding something, right? I mean, now ours are like max 20 pages, right? And that's because a lot of the legalese that go in. But if it gets ridiculously big, like annuity contracts, it's like, no, I gave you $100,000. You're supposed to give me 4% a year. Why does that take 50 pages to explain? Well, that's because there's stuff in there that you do not understand. Okay, the familiarity trap. This is the towards the end here. This is investing only in things you know. I I do like to invest in things I know, right? I'm very U.S. centric. I come from a military background. Obviously, I've seen what we can do when we don't get our way on the world stage. So I kind of think of us first and don't really sweat the rest. Um, I would agree that China's right there with us. So when you really look at my portfolios that I've designed over the years and my personal holding, it's been almost all US with some Chinese firms in there. A little bit of India, but it seems to never really take off. You hold it and it just doesn't do anything. And I sell it because I get frustrated. Um, but the you should be somewhat diversified in our models. We have a international holding to make sure you are holding emerging markets and the rest of the world that's out there, because US is not the only game in town. It is not guaranteed that we crush everybody till the end of time, regardless of your ability to think that we can, and we can, but it may not last forever, right? So you don't want to load up on things unnecessarily just because you're familiar with them. If you look down towards the bottom, most of us in here are old enough to remember Enron. So what people were doing was they would go to work for a firm, and that was obviously didn't, it's a great firm, right? All the made up ones are. The everything's perfect. So they would get gifted a lot of, or they would earn out a lot of stock with the employee stock purchase program. And then, so in their 401k, they're loaded up on Enron stock. They work for the Enron company. And on the side, they're also buying more Enron stock, because what could go wrong unless it drops 90% and you're financially devastated. So don't do that, right? So that's why you diversify. A lot of stock programs, we just advise that as you accrue that stock, as it vests, just sell it, right? You already have exposure if the company lets you go. You don't forget that even if you're a hero and there's age protection laws out there, it is very difficult to prove when they lay you off because you are too expensive that they're laying you off because you're too expensive, i.e., old, right? So they're going to go about that in a very careful way. But just because life's good now and you're making a huge paycheck and the stock's going great doesn't mean it all can't end fairly quickly. Like we just had like 19,000 people get laid off from Amazon. It's like, ooh, didn't really think Amazon was hurting. No, they're getting ready for AI, right? So they're starting to lay off people and replace it with some computer stuff. So there are some rules of thumb out there. Single stock exposure, 10%. I've always said you can go up to 25 if you're confident and you're right. Got to be right. Sometimes it hurts if you're not right. So 10% is probably pretty good for a home gamer. 25% if you really know what you're doing, or you really want, or if you can have the ability to hold through the situation. Okay, inflation trap. So one of my favorite things to talk about, again, it is the thesis for precious metals as well as Bitcoin, and kind of the future of the country is, we have this, we have the debt, 38 trillion. That's a lot, I think. I don't know. I think 1 trillion is a lot. So I don't know how many 38 times that is. It must be super lot. We're running a deficit right now. So the budget, we're spending more than we have. I think a little maybe to the tune of minus 4 trillion. So that's not great. And our dollar, the US dollar, which is the reserve currency of the world, it's the strongest currency that's ever been, I think is being challenged. If you look at that red line there and then go all the way to the, US dollar at the bottom, that's your inflation. So your dollar inflates away. So when you look at this picture, the left side of the picture is 1986. It's right before the stock crash in 1987. Remember the Black Monday. Stocks are the blue line. So if you invested in stocks, then up and to the right. If you invested in bonds, which is the green line, it goes somewhat slightly up to the right and really outpaces inflation until 2020. What happened? COVID. World was ending. We started putting free government money in the mailbox, thinking that might be a problem. So we kind of killed the bond market. So you're not getting the return out of the bond market that you used to. But if you're sitting there holding dollars in, say, Ziploc bags in or above your cupboards, that money is getting slowly inflated away over time. So just from 1987 to 20, whatever that is, 2028, it looks like, almost current, the year just past current, you've lost 60% of your purchasing power. So people are like, blah, blah, blah. I hated econ, so stop talking about this real versus blah, blah. So in other words, if you have $1 million today, that's about what 350,000 was in 1987. Or the other way, right? If you're a millionaire in 87, maybe that's your parents, maybe that's your grandparents. It takes 3 million now to feel the same way. Because I do get it all the time. Somebody's like, dude, I got $1.5 million. I am the brokest dude I know, right? It's like, I don't feel this millionaire thing. It's like, well, the millionaire thing kind of, and that was important back then. Now it takes a couple. right? So anyhow, the inflation trap is I'm just going to stay in money markets, CDs, cash. Just that is literally the walking to work scenario. That means I don't want to ride a bicycle because those are too risky. That's your bond market. I sure as hell don't want to get in the car because people die in those all the time. So therefore, I'm going to walk to work. That's the headwind you're facing. Yes, you can earn enough. Yes, you can work long enough to make it to the finish line. But yeah, if you don't take any risks, you're just not going to get the reward. And that's the inflation trap out there. Okay, confirmation bias. This is the think Fox and CNN. This is you only listen to what you want to hear. I don't know these stats, but I would say it's probably 100% that Republicans listen to Fox News, Democrats listen to CNN or MSNBC, or maybe nobody listens to MSNBC. But you go through life thinking a certain set of beliefs. You only receive that set of beliefs, and then therefore, you're taking your positions to an extreme. So therefore, if you have a thesis out there, it's never getting challenged because you're listening to the same people who think just like you, and therefore you get off into this extreme land. Maybe you've seen that in the political world. The one example I would use again from the Air Force is I was in a master's program in Montgomery, Alabama, and the first part of the class was you had to come up with a thesis for the first week. You had a thesis that you truly believed in. They're like, what do you believe the most that the Air Force needs? And mine was the Air Force needs more F-22s because we were right at that point. We were trying to figure out how many we needed, right? So I said, okay. So I laid out this what I considered a beautiful thesis, which my heart was behind. I knew I could stand in front of everybody, a firing squadron, and explain this on exactly why we needed more F-22s, and I didn't give a crap what anybody else had thought. So we all turned those in on a Friday. Monday morning, we got our assignment, which our assignment was to present the 180 degree opposite of what we truly believe. And the exercise was now how to structure an argument where your heart is not in it, but still structured appropriately with providing all the evidence, find all the case studies, and then present the other side of the argument. So two purposes of that exercise. One is to expand your brain. So if you think, expand your brain, then the other one is, out in the real world, a lot of times you have to serve others that believe differently than you, but they're your boss. So you do what your boss says, right? Not what you believe. But back to that, expanding your brain. So if you think Apple is the best tech company in the world, or they're a luxury firm that has a tech piece, or you think Bitcoin is the perfect internet money that's out there for a store of value, then when you go to if you look at the all the evidence out there is the blue circle, your beliefs are the red circle. You definitely want to get out of that purple area. You want to, when somebody said the other day, or I saw an article that said Bitcoin is a terrible store of value, and here's why. It's like, okay, I'll read that. And then, the argument was, and it's a valid argument, that if I take my chunk of gold and I put it in my safe, and 30 years later, and I go away for 30 years, and I come back and I open that safe and assume it's secure, blah, 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 the chunk of gold is going to be sitting there unaffected. And their argument was, if you do that with if you do that with Bitcoin, which is in a crypto wallet, the crypto wallets need software upgrades, they need protocol upgrades. It's like, so you have Bitcoin, you go away for 30 years, you come back, and you may have trouble getting into your Bitcoin. You can't just go, there's my Bitcoin, when you put your key in. And that was more of a quantum kind of thing. So I think Bitcoin's going to be fine with quantum, but it does have to keep pace, side by side with quantum, if you will. Okay. How do you protect yourself against all these things? You come out on a Thursday night, not just for the happy hour and the jocularity of the discussion. You come out and educate yourself on these things just so you can go, yeah, I do see myself falling into some of these traps. So you want to follow the plan, not the headline. So whether you're doing it yourself or whether you're working with somebody, again, you don't just take the plan and throw it out the window the first time you get punched in the face. And the market will do that for you. So wealth is a long-term accumulation of assets that go up and to the right. You get the magic of compounding along the way. Humility is a big deal. You do not have, no matter how much evidence you have that something's going up and to the right, it doesn't matter. The Michael Batnick the other day on the compound said there are pockets of extreme stupidity that exist all over the world, right? So you can see something not move with what you think should be guaranteed. And then the last case is that if your investments, if you ever lose confidence in your investments, you do need to talk to somebody, right? Because you are falling victim to some of these. So and you may not know what it is. It doesn't matter. You're just like, whatever I touch, you've got the death touch, right? Whatever I buy goes to zero. The next day, it's time to talk that out because you're not in a good mental spot. So, all right, what do we got for questions out there? All right, go ahead.
So, would you call Bitcoin an investing trap?
I will say there are lots of people that would call it an investing trap. There's still people calling it an investing scam, magic internet money, all of that stuff. So I wouldn't call it a trap, but I think the question is, so when you have Bitcoin as an asset class, and much like the silver chart that we pulled up, if you will, the silver chart, ran up to 120 not too long ago. It dropped down to 75. It's kind of, if you put a zero behind it, kind of did what Bitcoin did. Where you're looking at a 30 to 40% loss. Nothing changed with the underlying assets. So silver is the same, Bitcoin is the same. The only thing that changed is the price. So the asset itself is not a trap, but certainly things will move on you to where it will get into some of these traps that are out there, sort of how you handle it. So people say, okay, Steve, I know you believe in Bitcoin. It's like, yes, I do. Here's my thesis. I can clearly explain it to you. Will you hold it to zero? No, I will not. I'm not going to hold it all the way to zero. Right, there will be a point to get out if I'm wrong, and I could be wrong. But that's the way you have to look at all of your investments out there. Have a reason why you bought it, and if that reason goes away, you can feel free to sell it because you've now lost your reason. So, all right, any other questions out there? All right, thanks everybody for listening. Great question. You can clap. That's cool. Made like a designator in stream